Hello there, this is the Bookkeeping Master on YouTube. Welcome to this video. This is the first video of a series of videos that will cover payroll basics or payroll accounting basics. And in the first video to this series, I am creating a short presentation on going through a short presentation about wages journals. Now, these wages journals are specifically for the UK, but the principle is the same. It's double entry bookkeeping, so it's the same no matter where you are in the world. If you haven't already done so, please check out my website, freebookkeepingaccounting.com. There are hundreds of free videos to do with bookkeeping, accounting, business planning, credit control, and other aspects of accounting and finance. They're all for free. Just go to the website and watch those videos. So wages journals, they're not as simple as debit wages. So the wage from the business to an employee, say, is an expense. It's not as simple as putting that amount as debit and then crediting the current account or the petty cash or wherever that money is coming out from. It's not as simple as that. The reason why it's not as simple as that is there are so many other aspects to paying someone than just physically transferring money from a bank account to an employee's bank account. If you think of a wage slip, you will have things like gross pay, any deductions, say pension contributions or other deductions. You'll have tax information on there. In the UK, you have national insurance or NI details or information. You have the net pay, and then this doesn't show on the wage slip, but in the UK, the employer also has to pay NI. In other parts of the world, the employer has to pay tax. So it's not this simple. Looking at the top here, it's not just moving money from the bank account into the employee's account. Obviously, we have to record that too, but there are other things we have to record too, like gross pay, deductions, the employee's tax, the employee's national insurance contribution, their net pay, and the employer's national insurance contribution. So moving on to the next slide, wages journals, 4 steps. If you just remember there are 4 steps, there are 4 separate journal entries you need to make, then that may make wages journals a lot easier. Now I'm just going through the basics in this presentation, which will teach you the foundational principles of wages journals, but they can be slightly more complicated than what I'm covering in this presentation. So there are 4 steps or 4 sets of journals that you need to enter. Gross pay journal, a gross pay journal, the employer's national insurance journal, the net payment journal, and the tax payment journal. And you can separate these into 2 categories. These are recording expenses and liabilities. These are the actual physical transferring of cash from one account to another. If I go back, this slide at the top here, debit wages, credit the current account, that will be in this net payment journal here. Now there could be a 5th step, a deductions journal. Like I said, I don't want to make this more complicated than it needs to be, but this deductions journal could be another journal. You could also put this deductions journal as part of the tax payment journal. But these are things like pension contributions, as mentioned. So the first journal, gross pay journal. So looking at the top here, gross pay journal. This is the first journal that you'll need to enter, and it covers the total pay to the employee. And the journal would look something like this. If you're paying the employee £2,000, say this is for a month's work, it's a salary or a month's wages, you would debit £2,000 to gross wages, because it's an expense. That's how much the company or business is paying the employee, £2,000. It's an expense to the company, to the employer, to the business. So what are the credit entries? You will credit employee tax control, £500. That's the employee's income tax, say, £500. And that's a liability control. And I'll go through this again. You'd then credit the amount for the employee's national insurance contribution, and that will go to a control account too. And then you have a net pay control account, which is also a liability control account. Now, why do we do this? Why is it set up this way? Well, the debit entry should be obvious. It's an expense to the entity, £2,000. Gross wages is the expense. That's what's going to show on the profit and loss statement. And then the rest of these are liability accounts, liability control accounts. If you think of pearls, if I bring up a pen, if you've watched my other videos, you know what I mean by pearls. So these are our debits. These are the credits. So we have purchases, expenses, so debits, assets, then our credits, revenue, liability, and sales. These are liabilities. They're credit entries. Now, the reason we need to record this is at some point we are going to, or the business is going to, transfer what is owed to the tax authorities and what is owed to the employee, and we will clear these control accounts. They're simply liability control accounts. It's a liability to the business. Even though we're paying £2,000 to the employee is actually only getting £1,400, and the employer is responsible for making these payments. They deduct them from the employee's wage, and then they have to make the payments. So here in the UK, if I am employed and I get paid £2,000, I'm not going to get £2,000 in my account, and then I am responsible for making my tax and national insurance contributions. It's deducted automatically at source, and the employer is responsible for paying those funds over. So it's a liability. The employer owes that money to tax authorities. So with £500 tax, income tax, say, these figures are just made up. They're not that accurate. The national insurance contribution, £100. This could also be like social security payments. Net pay control, £1,400. Now we'll come back to this journal entry later on, and hopefully it'll make more sense as you see the other journal entries that are made. So that's the first set of wages journals. It's the gross pay journal. The second, and let me just say, this is probably the most complex out of all the journals. The rest are a lot more simple. So the second set of journals is the employer's national insurance journal. So as mentioned previously, the employer here in the UK has to pay national insurance. They have their own national insurance contribution to make when paying employees. So NI due by business / company / entity / employer, whatever it is. Debit employer tax account, £300. It's an expense. Debits are expense. It's an expense to the business for employing someone. They have to pay a national insurance contribution. So that's the expense. The credit entry, employer tax control, £300. Once again, a liability control. So let's go back again. As mentioned, these are the expense and liability journals. These are the actual physical transfers of cash, or cash moving from one account to another. So employer's national insurance, debit the employer tax account, it's an expense account. Credit the employer tax control account, which is a liability. So they might be worded very similar, but one's an expense account, one's a liability control account. Now, why do you do this? I think I've been through that already. Now, the third set of journals. Now, let me just stop here because you might be getting totally confused. I really don't mean to confuse you. If it helps, just keep watching the video over and over again. You can also go to my website, freebookkeepingaccounting.com, and there'll be a blog post all about this. So the third set of journals is employee pay journal, or the net payment journal. This is when cash actually starts physically being transferred. And this is to record the payment to the employee. So if we go back to that gross pay journal, the net pay to the employee is £1,400 after the deduction or deductions. So the net payment journal is the payment to the employee, £1,400. Look, credit the bank account, £1,400. Why do we credit the bank account £1,400? Because that's the net pay to the employee. That's how much we're transferring to the employee. And we debit the net pay control, £1,400, and hallelujah, it balances, it brings this control account to zero. So we owed our employee £1,400. It was a liability account. We owed that to the employee, and now that has been paid, it's been cleared, that account is cleared, and there's nothing left in that liability account. And then the tax payment journal. So once again, going back, the employer's national insurance, this money is owed to the tax authorities and needs to be paid. This money, the tax control, the NI control, needs to be paid to the tax authorities. So when that payment's made, we record that payment to clear tax owed. Credit the bank account or credit card account or whatever, doesn't matter where the money's coming from, credit that account. And then we just debit those control accounts to clear them off. The employee tax control cleared. The employee national insurance control cleared. The employer national insurance control cleared. And hopefully that makes sense. Now, it could be, if there are other deductions like pension contributions, that's also included in this tax payment journal. But it could be that there's then a fifth journal for deductions, where once again you'll credit the bank account and debit the pension fund or whatever the deduction is. As mentioned, if you just keep watching this video, it will make more sense as you watch it a couple of times. There'll also be a blog post about this, giving some examples on my website, freebookkeepingaccounting.com. If this video has been helpful, please like, please subscribe, please leave a comment. All these things help me. I don't do this for the full-time living. It's here to help you. If I can help you at all, drop me an email. Just check out my website. I'd really appreciate that. I also have a Facebook account and a Twitter account. Thank you for watching.